I know you've seen this, and I know you want these returns. So I built a tracker for you. So you can track any mutual fund and compare based on performance, risk, and cost. And right here, you'll know the result. And it starts with rolling returns. क्या बताना definition?
Annualized average returns for a period ending with the listed year.
ठीक से बताता हूँ. Wait. So we are on the Excel sheet and I'm in the performance tab. We have the fund names on top, so I'll put fund names. But I'm picking a random mutual fund. Do not invest in this fund. Do not do anything. This is just an example. So I go to this website called advisorcoach.com. Click on MF Research, then choose rolling returns versus benchmark. Here, I just type in the fund name, pick a start date, choose the time period, submit. Now you see this chart. Orange line is the fund, blue line is the index. It's Nifty 100 in this case. So for HDFC large cap, it shows 18.04% and the index is at 13.81%. I simply note that down in my tracker. Notice, I didn't use the current return, but when you do this, make sure to check the latest numbers. Then I do the same thing for the other two funds also, SBI Magnum and Nippon Small Cap. We need one more thing, which is rolling return versus category average. You can get this information following this. Now just look at all the numbers. You will see two of the funds did better than both the index and their category average. One didn't. So this is your first decision point. Remember, when you're doing rolling returns, compare many mutual funds and check for 5 years or more. 3 years I've done as an example, but returns aren't enough. The biggest problem in markets is risk.
We have seen a sharp fall, a crash in the Indian markets.
What if you lost a lot of money because of the mutual fund you've picked?
संपूर्ण लॉकडाउन होने जा रहा है.
India, very, very tough, very, very tough.
So I want to talk about risk right now, and it's called the Sharpe ratio. I'll get the laptop, please. Perfect. So this is Morningstar. You will have to type the fund name here and this new page will open. Click on risk and ratings, then select 3 years. Under the risk and volatility measures table, you'll see 0.75. That's the fund's Sharpe ratio. And 0.46. That's the category average. I'll put these numbers into the tracker and do the same for the other funds. You'll notice that the Sharpe ratio of all these funds is higher than their respective category averages. And that's where the Sharpe ratio comes in. It will tell you exactly how risky this fund is in relation to the returns it's given. And this reminds me of an interesting thing, and that is called standard deviation. So let's look at it, what it looks like on our sheet. This data has been sourced from the Morningstar website. So let's check the volatility of the funds we chose. 13.18%, 14.35%, 14.38%, 16.94%, 17.36%, and 17.43%. So if the fund's standard deviation is less than category standard deviation, it shows lower volatility, otherwise higher volatility. You can check for funds in your portfolio too. Just compare each fund's standard deviation with their category standard deviation and you'll know which fund is more stable and which one takes more risk. The lower the standard deviation is, the better. So now it's time for beta. Basically,
fund are subjected to market risk. Please read the document carefully.
फिर से बोल.
Music.
Okay guys, basically it's called beta. Whatever you invest in, there will always be some volatility. Now you want to make sure the volatility of your fund is not more volatile or too volatile compared to its benchmark. So let's say Nifty 500 or Nifty 100 or Nifty. Don't confuse this with standard deviation, which is measuring volatility of its own performance with itself. Beta is comparing relative. So now to understand beta, you actually have to see what it looks like on a freaking Excel sheet. Let me show you on 3 different funds what this looks like. Okay, now let's go ahead and enter the beta numbers into the sheet. This data has been sourced from the Morningstar website. We're comparing each fund's beta with the beta of its category. As you start filling it in, you'll notice 2 of the funds are on the conservative side and 1 is aggressive. Just to make it clear, if a fund's beta is lower than its category, it's considered conservative. If it's higher, that means it's aggressive. This gives us a quick idea of how much risk each fund is taking compared to others in its category. So, a beta of 1 means that it moves exactly like the market. A beta of greater than 1 means that it is more volatile than the benchmark or the market. And less than 1, you guessed it, it's less volatile. But does it always mean that more than 1 is bad? Not really. And for that, we have something called the capture ratio. The capture ratio is basically looking at whether your fund is capturing the upside and the downside of the market or not. Let me explain. Let's say Nifty goes up by 1% and your fund also goes up by 1%. That's an upside capture ratio of 100. If Nifty falls by 1% and your fund also falls by 1%, your capture ratio is now 100. So this means it is moving exactly like the benchmark. But what if the capture ratio is 120 on the upside and 80 on the downside? This means that it's going up higher when the market moves and it's falling lesser when the market falls. Now that's an ideal case scenario, but look at this example over here. So in the tracker, we have the funds upside capture ratio category, upside capture ratio, funds downside capture ratio, and category downside capture ratio. So let me put all the numbers here. Now look at HDFC's ratio. It is 103, which is more than the category average of 100. This means the fund is better at capturing the movement when the market is going up. Likewise, I've included the numbers for the other funds too, and this is the result. The next thing is the downside capture ratio. The downside capture ratio of your mutual fund tells you how much of the market's fall the fund is actually capturing. I've put the numbers here, and you can see all 3 funds' downside capture ratios are less than their respective category averages, which means they fall less than their peers when the market goes down. And that's always a good sign. So this is our final sheet, summarizing our analysis based on performance, risks, and cost. For rolling returns, we compared each fund's return with the benchmark and category average. For all other metrics, like Sharpe ratio, beta, and capture ratios, we've compared each fund with its category average. You can use this sheet as a ready reference to filter good quality mutual funds and build a portfolio that matches your goals. So notice how all of these things will intermingle and play. You have returns on one side, you have capture ratios, you have standard deviations, you have volatility. All these things are ways to tell us whether you're comfortable with that fund or not.